Now this is nothing new. We all know that our money gets devalued over time. There's more and more fiat that enters the system, and because of the money expansion we can buy less and less with our US dollars. That's why we are forced to invest. But once we look a bit deeper at how quickly is the money expanding and what kind of secondary effects does this have, we suddenly come to conclusions that are very uncommon. Most people don't think about this. Have a look at this here, right? This is USM2. This is the money supply of America. And it shows very nicely how we are expanding exponentially. We did have a bit of a drop because of our monetary tightening. Now we are expanding again. Nothing new here. However, what we see over here is the US GDP, so the output of the US economy. It looks very similar, right? It's growing over time exponentially. But the issue is that GDP is also measured in US dollars, and the US dollars are worth less and less over time. So how much is the economy actually growing if we take away the monetary expansion? Imagine the monetary base would not expand. This is the US GDP relative to the money supply. Since 1961, this went down by 26%. If you've got an economy with 10 apples and $10 and now you're printing another $90, then the apple is now not $1 but $10 each. On the face of it, it looks like the economy grew from $10 to $100, but actually really we still just have our 10 apples. And when we compare apples for apples, when we compare the output or the productivity of the US relative to its money supply, then is there really that much growth? Are people really better off? Chances are that your parents had it better at your age than you do. Maybe you don't yet have a house, maybe you don't yet have a flat, maybe your parents already had a house and a car, and maybe that's pretty much the same for all the friends you know, right? There's no surprise here. In the last 30 years, the US economy went down by almost 40%. Again, I'm looking simply at the money supply relative to the output. I'm not looking at the official inflation numbers. I don't believe those inflation numbers. We all know that things get way more expensive than what is officially measured. Now, what's also interesting is how the monetary expansion is pretty constant actually. Because when we look at the money supply on a logarithmic scale, not on a linear scale, and we see this is going up quite predictably, not always at the same rate, but somewhat similar. The rate at which this is going up is 6.8% per annum. If you don't grow your wealth by 6.8% per year, if you don't grow your income by 6.8% per year, then you're falling behind. Now, what can protect against this? The obvious choice is gold, right? Gold is known as an inflation hedge. Here is the gold price relative to the US money supply over time. And yes, gold was a pretty perfect hedge. The price pretty much did not move whatsoever in the last 65 years. No gain, no loss. But there was quite a bit of volatility. This is an 800% increase, and this over here is a 90% crash. Gold is really just a diversifier. It is also risky relative to money supply. Everybody always says that Bitcoin is the risky asset, but Bitcoin is just very volatile on the short term. If we zoom out and we look at gold relative to money supply, we also have that risk. Things simply develop a bit slower. A 90% downturn in purchasing power is what we have with crypto as well. And it doesn't happen just over 3 or 4 years, it happens over more than 20 years. One might argue, because Bitcoin moves faster, that Bitcoin is actually less risky in terms of purchasing power preservation compared to gold. Now, what's the second way to preserve wealth? It's of course buying stocks. And so this is the S&P 500 relative to USM2, relative to the money supply. And yes, this actually went up in the last 65 years by 46%. It's not a lot, right? It's less than 1% per year. But on top of that, we've also got dividends. But we also, unfortunately, have management fees. If you've got an actively managed fund, we've also got taxes. So it depends on how you're actually set up. If you've got a low-cost ETF and you hold for a very long time, then you might be beating inflation. But if you've got something actively managed, or if you get in and out of position several times, and if you've got to pay taxes, then you might not beat inflation with stocks. So are your costs, are your taxes higher or lower than your dividends? That's probably in the end what makes the big difference. Because I'm actually not so sure how sustainable those 46% gains actually are. Because this chart starts in 1960 roughly. But the price to earnings ratio of all stocks around that time was only at 19. Now it's at 38. So earnings got roughly double as expensive. If we were to go to similar price to earnings ratios to what we have seen at the beginning of the 1960s, then maybe we don't see any more outperformance of the S&P 500 relative to money expansion. Maybe we should actually see a 50% drop, which would put us over here. So that's then a loss of 27%. And so given that there's so much volatility in this chart, and given that stocks in general got more expensive relative to earnings over the time, it's not that clear actually if after fees stocks can beat gold long term. Of course, I've conveniently avoided the topic of fees for gold, but that's because you can, if you wanted to, simply just hold your gold in your own storage and not pay anybody anything, right? You don't have that option with stocks. Now here's finally an investment that beats monetary expansion, and that's the tech stocks. So this is the Nasdaq 100 relative to monetary expansion. And what we've got over here is our .com bubble. So from March of 2000 to October of 2002, technology stocks went down by 85% versus money supply. Again, people think that tech stocks are so risky, but gold has seen a drop that was way larger than that, again over a longer time frame. What we also see is that current tech stock prices are at very similar levels to the .com boom, again relative to the money supply. Now, is this justified? Probably yes, because our lives now are way more integrated with technology, right? We spend more on technology goods and services. And a lot of industry that used to be traditional, right? Let's say the traditional retailers, etc., they have now been replaced with e-commerce, for example. So seeing those elevated prices, I believe, makes sense. They make more sense than in the year 2000 at least. And so already from those kinds of comparisons, we can already say that there's no real safe asset, right? Every kind of asset can go down, relatively speaking, to purchasing power by 80 or 90% temporarily. Regular stocks can, gold can, and technology stocks, of course, can as well. Now, what about Bitcoin? Of course, Bitcoin can beat monetary expansion as well, but by how much? This is the Bitcoin price relative to monetary expansion. And of course, initially we had very nice growth with our drops of more than 90%. No surprise over here. We've also seen a drop of 85% relative to money supply when Bitcoin moved from 20K to 3.5K. And our recent bear market saw a correction of the Bitcoin price by 76%. Now let's try to draw something similar to what we already have for technology stocks. Let's start with the bottom of this chart. So here we go. This could be a pretty good approximation to where Bitcoin bottoms. We don't hit those bottoms all the time, but the bottoms do align quite nicely. This is nothing scientific, right? It's just a curved line. But again, whenever we hit this line, we tend to have historically nice buying prices. They tend to only happen every 2 to 3 years. How much could we go down in Bitcoin right now to achieve such a good level? Let's say we don't crash instantly. Let's say it takes a few months, then Bitcoin could go down by 64% relative to money supply. Since we are currently at around the 100K mark, this is quite a bit of a corrector, right? Most people do not expect that Bitcoin could potentially see something like this, at least if history is any indication. I'm not saying that we will hit this tomorrow, but I am saying that there is risk, right? We are not at historically cheap prices. Historically cheap prices look very different. You want to buy when nobody wants to buy, right? You want to buy after the Mt. Gox collapse, or after Silk Road has been shut down, or you want to buy when there's a COVID crash, or you want to buy when FTX blows up. You want to buy when people call Bitcoin a scam. Currently, there is no such voice, right? Currently, everybody is hyper bullish. It doesn't mean we can't go higher, right? We have seen quite nice extended rallies in the past of more than 1,000%. We are not yet up by 1,000%. We are only up by 500%. But still, I believe it's important to have proper risk management in place. Now let's do the same for the tops. Let's just connect the tops as we have seen them in the past. Again, just with a curved line. And this does not tell us the very best story, right? This tells us that we've already peaked. Now this is no exact science, because we could still connect those tops even if we were to draw this a bit higher. Maybe we can move this around somewhat, that we would still somehow connect those different data points, but it's really not that easy. The best approximation I could come up with is this line. So Bitcoin clearly protects against monetary expansion as well, and it tends to even outgrow monetary expansion. Very similar to what we see with the Nasdaq 100 with technology stocks. And my argument is that the risk in technology stocks and in Bitcoin actually is not higher compared to gold. Even though in the short term gold might look less risky because the daily price volatility isn't that high. If we zoom out though, if we just look at the purchasing power, right? If we look at how many dollars, relatively speaking, to the entire supply can we get with an ounce of gold, then that value can drop by 90% as well. It simply just takes longer. It simply just takes 20 years, not just 2 years. And it's not even clear that gold long-term underperforms stocks, right? Because now stock valuations relative to earnings are very, very higher. What is clear though is that technology stocks outperform monetary expansion because again, more and more industry moves towards tech. What's also clear is that Bitcoin can outperform monetary expansion. There's simply just so much volatility and people are scared of that short-term volatility, which I believe is a wrong way to think about it. The right way to think about this is that there's simply just more short-term volatility, and that's a blessing. This gives us very nice buying opportunities, and they also give us very nice selling opportunities. Now, is this the perfect selling opportunity? Again, I do not have a crystal ball. I simply know that we are currently not at a historical buying opportunity, right? We would have to be way lower than that. We would have to see some kind of bearishness in the market. Something has to blow up first. Now, here's the thing. There are plenty of topics within crypto that aren't very sexy, but that are, I believe, very vital to make money long term. For example, concepts like correlation. What we see over here are correlation coefficients. Did you know, for example, that most altcoins tend to be more correlated with Ethereum than with Bitcoin? In other words, it's not when Bitcoin goes up that the altcoins go up as well. It's rather when Ethereum goes up, then the altcoins go up as well. Or did you know that the correlation coefficient of the S&P 500 to Ethereum and thus the altcoin market is actually quite volatile? In other words, it does make sense to also own stocks, not just Ethereum, not just crypto. The common narrative is that when traditional markets go down, that crypto tends to go down as well, right? That crypto is simply just a levered bet on, say, technology stocks. That's not the case. The correlation coefficient is relatively close to zero. Or do you know the long-term expected returns of various asset classes, of say gold, of say the S&P 500, of Bitcoin, of altcoins? When we don't just own crypto, but we also own property, for example, and we've got that portfolio, what kind of returns do we need in order to beat monetary debasement, but also in order to at some point to get financially free? How much money do we need to have enough passive income to not having to work anymore? What are expected long-term returns, and how much should we actually allocate towards crypto and towards property, towards stocks, gold, bond, etc.? What actually makes sense? When there are tens of thousands, hundreds of thousands, maybe even millions of dollars on the line, not having this properly nailed down is a huge problem. And when the market isn't that great anymore and the upside for Bitcoin could be somewhat limited, how can we still make money? How can we make money from charts like this? What we see over here is Balancer relative to Ethereum. We can make money by shorting this. Balancer has very bad tokenomics. The supply increases over time, and so it tends to do worse than Bitcoin and Ethereum over the long term. And we can make money from that, again, from the relative valuations, not just from US dollar valuations. When we look at how quickly is the monetary base expanding, and we put this into relationship to how quickly are salaries increasing, we actually see that pretty much everybody is falling behind over time. And this is not just true for the poor people, this is even true for the top 5% of earners. By the way, if you earn $500,000 per year, then you are in the top 5%. But yeah, data like this is useful. And those are not necessarily the sexy topics that work well on YouTube, right? On YouTube, it's the 100x altcoin gems that get all the clicks. But when you talk about diversification and correlation, etc., people just fall asleep. But it's the long-term planning, the long-term proper allocation towards different asset classes that actually make the difference. And so have a look at all of this. Those are tutorial videos of the premium membership of this channel. It's down below, thebitcointrader.com. There's more than 100 tutorial videos in total. What are my favorite crypto macro indicators? How do interest rates impact different asset classes? We've just seen how the market got spooked because the Federal Reserve might get more hawkish. Or how do we adjust our returns for risk mathematically, right? Everybody can get more returns by increasing the risk massively, but the idea is we want to get the best returns for the risk. And so there are ways to calculate this using alpha and beta. Those are all very complex topics, but I strongly believe that it's the skilled people, the people that have most knowledge, that tend to make most money over time. Now, besides all of those tutorial videos, there are also various chats in premium where I try to be active as well. So in case you've got any questions, just tag me in a message in those premium chats and I try to reply. The membership is currently $165 per month. This is not for people that only have a net worth of $1,000, right? This is for people that actually have to manage wealth in the tens of thousands, preferably even hundreds of thousands of dollars. There is a 1-week money back guarantee as well. So in case you don't like premium, just message me within the first week and I refund you 100%. There's really zero risk for you. Now, if it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.